What is up, everybody? Welcome back to the Stock Trades YouTube channel. My name is Dan Kent. I'm one of the co-founders of Stock Trades. In this video, we're going to be going over a very popular ETF on the market. In fact, I would argue that it's probably one of the most popular dividend-focused and just overall ETFs in North America, and that is Schwab's Dividend Equity ETF, SCHD. There's a lot of misconceptions about this fund. There's a lot of curiosity as to why it has not performed very well over the last year or two when it got very, very popular because of the new influx of investors who were interested in a fund like this. I'm going to go over all of this plus much more in this video. So let's turn to the screen and get started right away. So before we get started, I just want to say smash that subscribe button, head down below, like the video, hit the notification bell if you want more videos in the future, particularly ETF reviews. And if you are looking to join what we call our No BS newsletter, there is multiple emails a week, free stock picks, market research, case studies, investment strategies, anything you like. Just head down below to the description of this video. There's going to be a link. You can sign up. It's absolutely free. There's no gimmicks, no frills. It's just a free twice a week newsletter. So SCHD, there's a lot of misconceptions about this fund in, quite a wide variety of ways. First off, a lot of people think that this fund is somewhat of an actively managed fund. I've heard this before. It's not. This is an index fund. Now, the index that it tracks has a bit of a particular strategy it uses to identify and pick the stocks inside of SCHD. That kind of makes this out to be, I would say, a value play, primarily because it focuses on yield. So I would kind of call this a large cap value ETF with kind of a dividend growth element to it. And stick around in the video because I'm going to dive into exactly how a stock gets picked to be placed inside of SCHD. But first, I want to go over the basics. So this fund has $53 billion in assets under management. And if we look to the trend of assets under management, this fund absolutely exploded post-pandemic. So we can look to, 2020, about 12% or about 12 billion in AUM. We fast forward to today, 53 billion. So a lot of investors love this fund post-pandemic, primarily because of its performance prior to that. But as we'll get to eventually, its performance post-pandemic has not been that good. It's lagged the S&P, whereas pre-pandemic, it actually used to perform quite well. And that's not to say it isn't performing well, it's just not doing as good as it is now, which is why there's been a lot of questions on this fund in relation to its performance and whether it's lost its touch. And by that, that's kind of why I'm given the indication that a lot of people believe that this is a actively managed fund when in fact it is an index fund. So when we go back to the main page here, we can see a net expense ratio of 0.06. I mean, this is about as cheap as it gets. You're paying 60 cents per $1,000 you have invested on this fund annually. This is practically free. I would consider this virtually free, especially considering you get exposure to 102 companies on the US markets that generally show strong fundamentals. You're getting that in a single click for 0.06. So the fund yields around 3.44%. And we can see as of late, the dividend is trending higher. And that's because of a drawdown in price. So prior to the pandemic, if we looked at the 10-year average dividend yield, this fund never really yielded in the high 3% range. It would get to the 3% range the odd time, but now we've seen elevated yields for quite a while. And even during, in November 1st, 2023, this fund was yielding nearly 4%. So right now it's around 3.44%. You're getting a higher than historical yield, which is what a lot of people would perceive to be value. Now, I would caution against that. Yield does not necessarily mean value at all times. So when we look to the allocation of this fund, we can see that it is 99% US. This is a pure play American ETF, US markets. It is also an all stock ETF. So when we look to actual sector exposure, we can see that it has a pretty heavy weighting towards the financial sector, not absurd, but heavy, and also industrials. And there is a reason for this, and I'm going to get to it. Remember, stick around. I'm going to get to it when I show you how exactly a stock is picked for this ETF, and you're going to understand why it has higher exposure to sectors like industrials and financial, and not a lot of exposure to technology, which is also where I'll get to in the portion where I speak on why it hasn't performed very good as of late. But you're seeing high exposure to healthcare, you're seeing high exposure to financial services, and high exposure to industrials. And again, there's a reason for this, and we'll go over it right now. So I'm going to click over to the top holdings here, but the first thing I want to do is actually go to the index that this fund tracks and its methodology when it comes to picking the stocks in it. Now, SCHD is an index fund, and it tracks the Dow Jones US Dividend 100 index. So this is a modified market cap weighted index, and it is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. So this isn't just a yield focused index. They use 4 key methodologies to determine whether or not a stock is suited for the portfolio, and then from there, they will tend to favor the higher yielders. So let's go exactly over how SCHD decides what is going into the portfolio. So the first 3 criteria, this is an absolute must. They must have a minimum of 10 consecutive years of dividend payments. They must have a minimum market cap of 500 million, and they must have 3-month average daily volume of $2 million a day. So they'll take the stocks that match all this criteria, and then they're going to sort them by yield. Now, they use a specific yield that does not include special dividends. So you could have a company that pays a very low base dividend and then pays special dividends based on free cash flow. This will likely impact their ability to be listed in SCHD because it does it off the base dividend and not including any special dividends. So first off, it does it based on those 3 criteria. Then it's going to sort them by yield, and then it's going to take the top half of those securities based on that ranking, and then they're eligible for stock selection. So they've screened them on the first 3 elements, then they screen them by yield, they take those half, and then they come down to the key metrics that they need to be included in the portfolio, or at least for selection. So the eligible securities, which would be the ones we selected above that pass the criteria, they are going to be ranked on 4 fundamental characteristics. So free cash flow to total debt. So this is the annual net cash flow from operating activities divided by the total debt. So companies with 0 total debt are ranked first. So you're going to have 0 debt, and then you're going to go down the list, and companies with more debt relative to their free cash flow are going to be underneath those with 0 debt. So return on equity, this is the annual net income divided by the total shareholders' equity. You're going to filter stocks that have higher returns on equity. This is a very important metric that determines, for the most part, the quality of the company. So you're going to then search on the yield, which this IAD yield, that's just strictly the company's yield, not including those special dividends. So they're going to search it on yield, and then they're going to search the 5-year dividend growth rate. They're going to give more precedence and favor companies that have higher dividend growth rates rather than those who meet all these first 3 metrics but don't necessarily have high dividend growth rates. So all 4 of these factors are equally weighted. So every single factor here has a 25% impact on a company's total score, and from there, they create a composite score, and the eligible securities are ranked based on this composite score. So the 100 top-ranked stocks by the composite score are selected to the index, subject to the following buffer rules. So the constituents will remain in the index as long as they are among the top 200 rankings by composite score. So if you get into that top 100 and then you start falling down, they're not going to remove you from the index until you drop out of the top 200. Secondly, non-constituent stocks are added to the index based on their rankings until the constituent count gets to 100. So this portfolio holds 100 stocks. This index holds 100 stocks. So if two non-constituents have the same composite score, the non-constituent with the higher dividend yield will be selected. So they will always prefer yield when all else is the same. So in terms of weightings, stocks in the index are weighted quarterly based on a capped FMC weighted approach. No single stock can represent more than 4% of the index, and no global industry certification standard, which would be technology, real estate, utilities, etc., can represent more than 25% of the index. So this is pretty much hard set rules for allocations. If something were to go over this amount, they would rebalance. So that's pretty much it. That is how the stocks are selected in terms of allocation for SCHD. And as a result, we get a total holdings list that looks a little bit like this. Now, I'm using Y charts here. It's not exactly the same as what is on the website, but for the most part, I cross-reference this, and you're talking about maybe 10 or 20 basis points in terms of total differences, give or take. So with say Broadcom, it might be 5.2% or 4.9% instead of 5.07. It's very minor. This, at the time of filming this video, is going to be, for the most part, the holdings within this fund. So we can see at the top end of things, we have a company like Broadcom, which is an excellent dividend growth stock. It's got outstanding returns on equity, excellent dividend growth stock. It's a semiconductor play, which has caused it to just rocket in price. We have AbbVie, which is a very successful pharmaceutical company, especially with the hit that pharmaceuticals are taking at this point in time. AbbVie is night and day above something like Pfizer, which is actually included in the portfolio as well. Pfizer has really struggled. We have something like Home Depot, which is one of my largest positions actually, but it's definitely in a bit of a cyclical downturn just because of the overall economy right now. We have Verizon's, which is a U.S. telecom company. They've really struggled, rising rates, debt levels, just overall competition in the space. Chevron, oil and gas company, again, over the last while, they have not done very well. Texas Instruments, another semiconductor type play that has a strong dividend growth rate, but it's really struggled over the last bit. BlackRock, one of my largest positions as well. However, it is in a bit of a rut just due to the fact that the markets aren't as popular as they were during the pandemic. Lockheed was doing very well before the war in Ukraine. That tailwind kind of went away, and now it's just kind of doing so. And then we get to stocks like 3M, which has really struggled over the last bit. They're not really raising the dividend that much. Their stock price has taken an absolute beating over the last 5 years. Ford, very cyclical company, but overall, it's kind of balanced in a way. There's a lot of holdings here. They don't really make up a ton of the portfolio. I wouldn't say it's equal weighted, but I also wouldn't say that it's really top heavy. So, it's got exposure to 104 of probably the best dividend growth stocks, large cap dividend growth stocks in the United States. And again, if we go back to the allocations, you can see that this is pretty much a large cap value and large cap blend play. So you're looking at 70% of this fund is either large cap value or large cap blend, another 5% with large cap growth. There is virtually no small cap exposure in this fund, although the criteria for that Dow index is 500 million in market cap or more. 2.52%, about 4% exposure to small cap stocks. So you're not really going to get that with SCHD. So in terms of performance, how has SCHD performed? Well, it's performed pretty well. When we look to it on a benchmark basis, remember, this is an index fund. It aims to track the Dow Jones U.S. Dividend 100 Index, which it has done very well. You'll see that it slightly underperforms, but that's going to be the same with any index fund. It's not going to be able to keep up with the index just because of just relative performance drag. You have to pay fees to the fund. There's other expenses within the fund that they might charge you. So you're going to underperform the index by a slim amount, but we're looking at 10-year annualized returns of around 11.14%, or sorry, 11.03%. The index itself is 11.14, so that is pretty strong. When we look at it in relation to the S&P 500, which is probably the index that I would benchmark this against rather than the Dow Jones Dividend 100, primarily because I believe a lot of investors should be seeking total returns. And when I'm looking to buy a concentrated portfolio of US equities in a fund, I would always benchmark that fund against something that I could buy like SPY. So outside of this, when we reinvest dividends, they have very strong returns, both SPY and SCHD. When we go to annualized values, we can see that over the last 10 years, SPY has a 12.61% annualized return, whereas SCHD has an 11.41%. However, when we erase the big run-up in big tech and we go back to, let's go back to November of 2023, let's say to the end of November of 2023, the returns do get a bit closer. I mean, you're talking about a 12.52 annualized return for SCHD, whereas SPY is 13.62. So for the most part, simply buying a broad-based S&P 500 index fund has outperformed SCHD. And again, this is with dividends reinvested. Now, why has SCHD, particularly in a post-pandemic environment, struggled? I mean, when we look to the last 3 years of the fund, we can see it's pretty much traded flat. I mean, especially if we isolate this actually to 2022, you'll see that it gets even worse. SPY has returned just over 19%, whereas SCHD dividends reinvested 7.51. So it's really struggled. And for the most part, this just has to do with the fact that it has a bunch of cyclical holdings inside of it. If we go to the allocations here, there's a lot of industrials, which are very cyclical. There's a lot of financials, which again are very cyclical. There's been a technology boom, which this fund does not have very much exposure to, primarily because technology stocks, a lot of them are fast growing. A lot of them don't have 10 years of dividend paying history. A lot of them have very little dividend growth history. You'll get the odd ones, obviously, like Microsoft and like Apple. They're not included in SCHD, but you're, again, going to get that industrials, which is cyclical. You're going to get energy, which is very cyclical. Financial services, very cyclical. Healthcare, a lot of healthcare companies, especially, mega cap healthcare companies like Pfizer, are a bit of bond proxies, I would say, which means they're inversely related to interest rates. They're really going to struggle when interest rates rise. And we can pretty much pinpoint SCHD's flat performance since interest rates started to rise. I mean, if we look here, we can see all-time highs were set back in January 2022. When did interest rates start rising? July 2022, so, shortly after. And ever since then, we've kind of been in a flat trend here, whereas SPY has increased primarily just due to that mega cap tech exposure. Overall, if I'm being completely honest, there's a lot of holdings in here that I'm not necessarily a huge fan of. Cisco, Coca-Cola, I'm not too hot on. 3M, I'm definitely not hot on. Verizon's not a fan. Pfizer used to be a fan, but they've had a really tough go about things post-COVID. I'm just not a huge fan of a lot of the companies inside this portfolio. Again, this is more of a large cap value play that focuses on dividend growth and, when all else equal, dividend yield. So if you're somebody who's seeking a little bit higher yield, 3.5%, that's probably one of the higher dividend focused funds you're going to get, especially one that's performed this well. Obviously, it hasn't performed as well as SPY. You can find different areas where it has outperformed, where it has underperformed, and you could argue that it potentially could outperform moving forward in the future, just because of the fact that the S&P 500 is so focused on that Magnificent Seven, whereas the Schwab US Dividend Equity ETF has a lot of stocks that are kind of beaten up right now and could certainly rebound in the future. Overall, I'm actually a pretty reasonable fan of this ETF. Would I personally buy it? Probably not. If I was going to buy a concentrated, index fund of US stocks, I would just buy the S&P 500. If I was worried about the exposure, I'd probably just go equal weight if I had to, rather than own this. But I do not doubt its attractiveness to somebody who is income focused. And it's not like this is like a super high yielding fund that holds a bunch of poor companies, which obviously yields high when price is down. This isn't the case with SCHD. It's actually got a ton of great holdings inside of it. They've done very well in the past. The fund is super low fee. It's got a ton of AUM. It's going to grow in popularity moving forward. And overall, I really don't blame people who want to own this thing. I don't really see too much wrong with it. It's got a pretty sound methodology for selecting the stocks in the Dow Jones 100 index. It's not exceptionally yield focused. It looks at, fundamental aspects such as debt levels, returns on equity, things like that before choosing yield. And overall, even though I wouldn't own this, just because I'm an investor that focuses on solely total returns, I don't doubt its attractiveness from a dividend growth standpoint and an income standpoint. I hope you like this in-depth video on SCHD. Again, head down below, subscribe to the channel, smash that like button, make sure you hit the notification bell so you get our next ETF review. And again, if you want to join our No BS newsletter, head down below in the description. There's going to be a link you can click, enter your email. It's absolutely free, no gimmicks. You're going to get 2 emails a week that will go over stock picks, industry analysis, market commentary, investing strategies, case studies, everything you can imagine. And we'll see you next time with another ETF review.